Have you ever thought about whose pocket your money is actually flowing into while the value of the money in your pocket is decreasing? History keeps teaching us the same lesson over and over again. When an economy collapses, the wealth that disappears doesn't actually vanish, it merely changes hands. In the shadow of every crisis period filled with panic, fear, and bankruptcy, a small number of people who kept their cool, read the risk correctly, or were simply in the right place at the right time, managed to gain what millions lost. This video tells the story of how wealth changed hands during the greatest economic upheavals of the last 150 years and who emerged stronger from these storms. Our story begins with one of the first major systemic crises in modern financial history, the Panic of 1907. America's banking system still lacked a central bank. Loss of confidence spread like a spark. The New York Stock Exchange lost half its value within days, and banks closed their doors one after another. In the midst of this chaos, the most powerful banker of the era, John Pierpont Morgan, hosted meetings in his library that determined the fate of the financial world. Morgan used his own wealth and influence to provide emergency cash to banks, merged collapsing institutions, and effectively assumed the role of a central bank. However, Morgan's intervention was not solely an act of sacrifice. During the panic, the struggling Tennessee Coal, Iron and Railroad Company, a major steel and mining company, was purchased at a considerably low price by U.S. Steel, which was under Morgan's control, with the government's approval. This single transaction consolidated the monopolization of the U.S. steel sector while further expanding Morgan's empire during a moment of crisis. The Panic of 1907 permanently changed how governments intervene in crises and paved the way for the establishment of the American Central Bank, the Federal Reserve, 6 years later. 10 years later, a very different crisis was budding in the heart of Europe. Following World War I, Germany was dragged into hyperinflation under the weight of both war reparations and a collapsed economy. By 1923, the German mark had become so worthless that people went to banks with wheelbarrows to collect their wages, and a loaf of bread was selling for trillions of marks. While retirement savings evaporated overnight, industrialist Hugo Stinnes wrote one of history's most remarkable wealth stories. Stinnes took massive loans from banks and bought mines, newspapers, hotels, and factories with this money. Inflation was so rapid that by the time he repaid his debt, the real value of the money he paid was much lower than the loan he had taken. Thus, Stinnes built a massive industrial empire on top of a collapsing currency and became one of the richest men of his time. Hyperinflation destroyed savers while enriching those who used debt to invest in tangible assets. This lesson would be repeated many times over the following century. By the fall of 1929, the world would witness a much larger collapse. The New York Stock Exchange crashed in October after years of speculative rise, opening the doors to the Great Depression. While millions of investors lost all their wealth, the well-known businessman of the time and future first chairman of the United States Securities and Exchange Commission, Joseph Kennedy, followed a different path. According to the famous story, when Kennedy noticed that even a shoe shiner was giving him stock tips, he concluded that the market had reached a dangerous point where even ordinary people were speculating, and he sold most of his shares before the crash. This foresight allowed the Kennedy family to preserve their wealth and even grow it by investing in real estate and companies that had fallen to very low prices after the crisis. Kennedy's experience would ironically carry him, a few years later, to the head of the institution that would regulate the stock market. Among the wreckage of the Great Depression, there were other names who acted with similar logic. Investors who held cash or had little debt found the opportunity to buy crashed stocks, bankrupt companies, and changing hands real estate for almost nothing. The small number of investors who had been cautious before the crisis, had not overborrowed, and had preserved their cash, ended up taking over most of the wealth around them by the end of this decade-long economic catastrophe. This period went down in history as a lesson proving that financial discipline and patience are the most valuable capital in moments of panic. About 70 years later, in 2008, the world once again experienced a similar shock, but this time the source of the crisis was much more complex. A bubble inflating in America's housing market and fragile financial products built on top of this bubble. Very few people foresaw that this system, where risky mortgage loans were packaged and sold to the four corners of the world, would collapse. One of them was Michael Burry, a medical school graduate who managed a California-based investment fund. Burry noticed the rot in the mortgage market years earlier and convinced banks to create financial instruments that would allow him to bet against this market. Despite the mocking reactions of his investors and the market, he insisted on his position, and when the market collapsed in 2008, he provided extraordinary gains to his fund. Hedge fund manager John Paulson, who applied a similar strategy on a much larger scale, executed one of the most profitable transactions in financial history with his investments against the housing market collapse. His fund and he himself made billions of dollars in the crisis year. These names once again showed that the crisis doesn't hit everyone equally, that those who make the right analysis and act boldly can obtain enormous gains at the very moment when millions are being destroyed. Another important actor of the 2008 crisis was Warren Buffett, the most recognized name in the investment world. As markets collapsed and major financial institutions were on their last legs, Buffett once again put into practice the principle of be greedy when others are fearful. He made billions of dollars in investments under very advantageous terms to giant companies like Goldman Sachs and General Electric during their troubled times. As these companies emerged from the crisis and recovered, Buffett's investment company Berkshire Hathaway both made great profits and consolidated its reputation in the financial world. Buffett's strategy was surprisingly similar to the path J.P. Morgan followed in the previous century. He saw the crisis not as a threat, but as an opportunity to acquire strong but temporarily distressed assets at favorable prices. After the 2008 crisis, governments and central banks implemented trillions of dollars in monetary expansion to revive the economy. This policy brought interest rates to historic lows, while also pushing up the prices of assets like stocks and real estate for years. Those who owned assets, namely those who owned stocks, real estate, or companies, significantly increased their wealth, while the broad segments who had no savings or were dependent only on their salary mostly couldn't get a share of this wealth increase. This situation was frequently discussed as an important factor in the deepening of income and wealth inequality in the post-2008 period. Our most recent example is the global pandemic crisis experienced in 2020. The COVID-19 outbreak brought the world economy to a standstill within weeks. Millions of people lost their jobs, small businesses closed. However, during the same period, the explosion in demand for working from home, online shopping, and digital services brought unprecedented growth to technology companies and their shareholders. The stock values of companies like Amazon, Tesla, and similar ones increased many times over in a short period. The wealth of the founders and major shareholders of these companies broke historical records even during the most severe months of the pandemic. The massive monetary supports applied by central banks against the crisis also once again pushed asset prices upward, increasing the wealth of the segment that already owned assets. When we put all these examples side by side, a repeating pattern of history emerges before us. Crises transfer wealth from one hand to another rather than destroying them. Those who can remain calm in moments of panic, those who manage their debt and cash correctly, those who can see risk early, or those who simply know the rules of the system best, seize the opportunity right in the middle of the collapse. From J.P. Morgan's library in 1907 to the inflation spiral of 1923 Germany, from the collapsing stock market of 1929 to the mortgage crisis of 2008 and the pandemic of 2020, the same truth confronts us. Economic disasters change not the amount of wealth, but whose hands it's in. The painful and real thing is that history continues to silently watch us, having repeatedly proven that this cycle will be experienced again with the next crisis. We would be very happy if you subscribe to our channel and support us. See you in the next video.